Okay, welcome everyone to Fogel and Potamianos presents the 2025 M&A and Alternative Investment Forecast. We are so glad to have you here. This is being recorded, so if you want to send this out afterwards, we'll be sending it to everyone who's attending today or who registered to attend. We are going to get right to it. Some of the things we're going to be talking about today, we're going to be talking about the effects of the tariffs. We're going to be talking about interest rates. We're going to be talking about the overall landscape of M&A and alternative investments. And we have our all-star panel today. Very excited to have some returning guests today. We have Mr. Cesar Bello. He is the partner at Corbin Capital, which is based in New York. Cesar leads the litigation finance practice there and is a multi-strategy alternative asset manager with about 10 billion in AUM. And he also had a long career as an attorney before joining the investment team there. Welcome again, Cesar. We're so glad to have you again today.
Thanks, guys. Happy to be here.
We've got Jason Somerville. Welcome back, Jason. He's a partner in a boutique advisory firm called GW Partners, where they advise primarily consumer-focused, founder-owned businesses in the lower middle market, mostly on the sales side and M&A work. Jason, welcome again to another one of our virtual panels. We're so glad to have you today.
Thanks, Christina. Great to be back.
Awesome. And we've got Robert Daly. Hi, Robert. We're so glad to have you for the first time joining us. Robert is a managing director investments at the Summa Group of Oppenheimer and Co. And as a wealth manager, his focus is working with primarily entrepreneurs, senior executives, founders, or people who are experiencing life-changing financial events such as inheritances, divorce, stock sales, or closely held business sales. And Robert, we're so glad to have you here today. Thank you for your time and your expertise.
Thanks, Christina. Looking forward to the conversation.
Yeah, we're excited to have you. We have got Jerome Fogel. He is the co-founder of Fogel and Potamianos. He is known as the deal maker and innovator in the legal community and represents successful corporations, venture and hedge funds, and sports superstars. Our very own Jerome has a 360-degree view of deal making as he represents emerging companies, raising capital, venture funds, deploying capital, advisors and investors, and private companies in mergers and acquisitions, and is the brains behind all of our virtual panels. He's the visionary here. So thank you, Jerome. We are excited to hear from you today.
I would say co-brains and visionary because we got Constantine here, but we've got a great team. But what a great panel, and really excited to learn from everyone here today.
And of course, we have my co-host, Constantine Potamianos. Always glad to co-host with you, Constantine. Co-founder and head of our corporate practice group. Constantine is an experienced lawyer who has counseled public and private companies on a very broad range of corporate and securities matters, including business entity formation, public and private offerings, mergers and acquisitions, securities registration, SEC compliance, corporate restructuring, also a veteran of the military, and just brings so much wisdom to every single panel that we have, so much just depth of experience. So excited to co-host with you again, Constantine.
You are far too kind, Christina.
I do my best.
Always a pleasure.
And then there's little old me, Christina. I have been on the team for about 3 years. I will be co-moderating, and a little bit about me. My husband and I are actually pastors, and we have a podcast called The Downlowed. And I'm the executive director here at Fogel and Potamianos. Just excited to be here to help facilitate this amazing conversation today. I'd love to start with just a little snapshot of throwing it to you guys of what's going on in your world, and just get maybe like a 30-second snapshot from your own voice of, what you do and what's going on in your world right now. Would love to start with you, Robert.
Yeah, so obviously there's been a lot of chaos going on over the last couple of months. And for us, we're, been the voice of calm with our clients. A lot of clients that are going through liquidity events, transactions, dealing with different events going on. We're just reiterating that if you don't need to do anything, don't do anything. Don't make any rash decisions right now. Let the market settle out, and just make sure you have a good team in place. So the attorney, the accountant, the banker, everyone on this panel, just make sure you have a solid team around you, and kind of take your time and take a step back.
Love that. Thank you so much, Robert. Jason, what's going on in your world these days?
Oh man, I mean, I think that I like that word chaos. I think that's pretty fitting. Um, as you said at the beginning, we focus a lot in the consumer sector. So, one of the obviously hot topics around the country is the tariffs that kind of are coming and going and coming and going and pausing and starting and whatever, kind of all in between. So, a lot of our clients are affected. They source their products and have them manufactured outside of the US. Many of our clients do. So that's very much kind of working through that, contingency plans, trying to plan for, situations where you don't have a lot of visibility. So that there's a lot of that going on. And then in terms of the kind of M&A and investment side of that, obviously that has a ripple effect. And whether that's people acquiring businesses or investing in companies that have exposure there directly. A lot of times things like this put people on pause, right? It's kind of everyone stops. They want to wait and see what's going to happen. And then until they get that maybe additional clarity, it's hard for them to want to kind of start back up again. So yeah, but again, there's all kinds of things throughout history that have caused these periods to occur. We have a certain set of variables right now. So it's not like it's new, this kind of volatility. It's just being caused by something that is a little bit newer, let's say, is looking at over the last, say, 30 years or so. So yeah, so no dull moments in our world, that's for sure.
Right, right. Thank you so much, Jason. And how about you, Caesar? And then we're going to go into our very first question with you, Caesar. When you give us what's going on in your world, we'd like to also just ask, like, should we be greedy or should we be fearful in this environment?
Yeah, a lot of what Robert and Jason already said, it is pretty volatile. People tend to shrink and, not want to do a ton of stuff when there's a lot of uncertainty. For us, we're the firm as a whole is more relative value investor, so we can do private credit, traded credit, so equity market. So one interesting thing we've done is just paused all of our illiquid investments for the most part, except for my strategy, which is different, and just waiting to see if the public stuff, which is more liquid, gets cheap. So it's a good example of what you guys are talking about. We're doing it. We've sort of shut down our regular kind of private credit activity for the most part. The good news about what's going on, I think, is it's a total sort of own goal. So while it was done with a tweet, it can be undone with a tweet. So we'll see how we manage through this and what actually sticks. But nobody really knows what's going to happen, so everybody's just kind of watching. And in terms of being greedy, it's interesting for me in particular because I sit at a big desk, open trading desk, and everybody has been concerned, and it's been an interesting time to hear all that. My book is litigation finance, so it's truly uncorrelated and unaffected, and we've actually had some positive kind of settlements and stuff happen on the back of this. So it's sparked some interest, I would say, renewed some interest in our strategy, because I think one general lesson is when stuff that's weird and unexpected happens, things that you think are uncorrelated aren't really that uncorrelated, and sort of all correlations go to one, and stuff starts moving together, and people start trying to sell at the same time. And lucky for me, the risk we're taking is idiosyncratic legal risk, so it is truly uncorrelated, and I'm sort of not as bothered personally, although I'm obviously paying attention to everything, right?
I would add too, I mean, I think to your point, with VC kind of markets frozen in 2023, and then people were clipping 20% coupons in the market for 2 years. I think what we're seeing is a renewed interest from LPs in alternatives, saying, okay, we've kind of forgotten this class became the ugly stepchild, but now there's a renewed interest saying, okay, now we have to pay attention to this class again. So we're seeing, funds being active, PE looking for platform companies, venture deals that are, you know, various series that are going out and raising, and there's interest. Obviously, it's tempered by all the tariff risk and supply chain that they have to diligence, but I do think it's creating a renewed interest in the private markets because things are turbulent and unpredictable. And so I think to piggyback on what you said, Caesar, I think we are seeing that you know, renewed interest.
Jerome, you know, it's one area like Caesar had mentioned about non-correlated assets. We always see that phenomenon happen over short periods of time in difficult markets. Correlations tend to go to one, assets go up and down together. But over longer periods of time, what we've noticed is that those correlations tend to go back to where they were before. And so, again, going back to not making rash decisions during periods of stress or dislocation, not trying to trade or move things around is one of the best things you can do, almost like doing nothing at certain points. And the other point I was going to mention is we're also noticing LPs and certain funds need liquidity. And with the IPO and the M&A window kind of dried up, there's been some secondary funds that are going out there and buying. They're providing liquidity at deep discounts, but the secondary market is huge right now.
Are you talking more about private equity or private credit or both?
More about private equity, where, you know, they had a venture debt or a venture fund. They've got like, you know, 100 LPs. They got 10 portfolio companies. They're 5 to 7 years in the cycle. They should be going public right now. You know, someone needs liquidity for a personal reason or estate planning reason. You know, these secondary funds are coming in and offering liquidity at a discount, but it is it's an interesting opportunity right now because we are always looking for different non-correlated assets. That's one of them right now.
The secondary market is hot. I know also too because the LPs, those are the consumers for the funds, and as they're raising, you know, different funds like Fund 1, 2, 3, 4, they want to return capital to LPs so that they'll re-up. But sometimes LPs have to take a leap of faith and say, okay, you know, we're going to re-up with you before we have returns. And so I know that, you know, the GPs are itching to get returns, and so these secondary markets are, yeah, they're definitely very active, and there's funds being raised just to do secondaries right now too.
Yeah, and I would add to that, there's two ways to think about the secondary market. There's like continuation funds and secondary markets for the GP, and there's the LPs who could just be selling their interest. I think Robert was talking more about the latter, and you're talking more about the former.
Good distinction. Yeah.
An extension of that we've seen people do to create that DPI, you know, over the last year has been more NAV loans and more sort of borrowing to get money back out to LPs. So we are pretty active actually in the private credit secondaries market, which is not nearly as big as the private equity secondaries market, but it is still quite large. And you do have this phenomenon of funds that are old in the teeth, they're LPs who are fatigued, and you picking some stuff up at nice discounts.
Let me ask you guys something, if you don't mind. So we talk about alternative asset classes. What I've kind of noticed over the past year is the continuing growth and to a certain extent institutionalization of the crypto markets. And you know, it goes back to a comment earlier that was made that correlation comes to one. You know, we always said, okay, crypto is not necessarily linked to the underlying equity markets and everything else. The reality is it still is, because, you know, if panic spreads across the board, people sell everything. They don't care about what particular asset class it's in.
Unless they have Robert advising them, then they stay calm.
Well, yes, yeah. A good plug for Robert. But how do you guys see that playing into the whole alternative asset class for investments? Robert, are you guys looking at anything in that sector?
You know, I mean, we follow it. However, due to compliance rules and regulations beyond, I don't even want to go into it, we can't touch anything in the space. So we're kind of more observants from the sidelines at this point.
Okay.
Well, I think, Constantine, I mean, one thing that I think is not debatable is that the current administration is crypto friendly, right? They're
right.
pro crypto. I think, you know, and it's a space I don't play a ton in, but I think unfortunately throughout that world, not everything is equal, right? Your Bitcoins, are different from some of the other types of crypto out there. And I think there's also been, going back to the idea of correlation, I think there's been this idea that crypto has been correlated to with kind of the tech sort of stock, kind of trade, that there's been some correlation there. I think that looks like it's decoupling a little bit. And I think more than likely over these next few years, Bitcoin in particular, which is where I think a lot of the focus is from the administration, trades a little more like a store of value, like the digital gold promise that, everyone's always kind of made about it. And I mean, I know that I see it in more and more portfolios, and it's kind of making its way into allocation where possible, where guys can actually, include it. So yeah, as far as any sort of buy or sell recommendations, obviously not doing that, but I would say things appear bullish, at least especially from an administration standpoint. So, and I think there's also there's a currency aspect there as well. As the dollar fluctuates, I think you're going to see some movement into it, so including from maybe foreign owners of dollars who may be selling dollars to buy crypto.
Caesar, any activity in any of your funds in that sector, or are you still staying
No,
away?
we don't really play there. It's not any
Okay.
part of our core competency, but I will echo what Jason said. I mean, they seem to have significant tailwinds from the current administration. You'll note they announced that they were going to be buying Bitcoin in particular as a reserve. Obviously, they have a lot of tech, crypto focused people in the administration. So.
Mhm.
When we did, I mean, also too, last point I guess I'll make, Constantine, is to the point about the panic selling. I mean, you did see kind of Bitcoin, which I can't remember where it bottomed out recently, but had kind of rode up, has ridden back up almost to 100,000. Kind of bounced pretty hard away from that kind of panic selling. Now it kind of followed a little more of that path of, is it more of a safe haven? It's obviously, I mean, you saw, I mean, gold's always had a big run as well.
Yeah.
For similar reasons. So we saw the decouple happen a little bit in real time.
Any thoughts, speaking of just macro effects, any thoughts or predictions, Jason, on your side on where you think interest rates are going at all?
Oh, that's a tough one, right? I don't know. I would say, look, obviously
You'd make a lot of
Powell's
money if you did know.
Powell's getting a lot of pressure publicly, of course, right, from the president. That's no secret. I think that it's going to be a tug of war between growth slowing and trying to fight inflation. I think I wouldn't want to be Powell right now. I wouldn't want his job because I think it's going to be tough, because I think with a lot of the things going on are going to be pro-inflation and kind of anti-growth. So, and those are because those obviously work in opposite directions from the Fed point of view. So I don't know. I mean, I think the safe money is probably on things staying pretty range bound, because it is kind of almost opposing forces, kind of pulling in two directions. But yeah, beyond that, it's tough right now, especially not knowing where tariffs may actually end up. I mean, we know where they are today, but doesn't mean we know where they're going to be tomorrow.
And it's hard to understate how important the tariff question is to that question, right? Because what we potentially see is, increased tariffs driving inflationary pressures kind of across the board for a lot of things. And if that's the case, the Fed, I think, is going to be very reluctant to drop rates very quickly.
Yeah, I think there's two major clashing agenda items for the administration, because on the one hand, they want to get rates low. They're very focused on the deficit, how much we're paying in interest, right now, given the size of our deficit. But on the other hand, they want to do the tariffs, but that is clearly inflationary. So those are competing interests. And it's hard to reconcile that. So, we saw Trump come after Jerome's independence, and thankfully that's sort of cooled down a bit, it sounds like, because markets are not like that. But those dual goals of the administration seem to be at complete odds with each other. So we'll see what happens. But I think Jason's right. Like stagflation, higher for longer, is probably my base case.
I think what we're also starting to see is that the administration is realizing that its actions have real world consequences in the markets. And that, I think, is starting to affect their thinking, right? The back and forth on the tariffs, as you were saying, talking to your treasuries guys and seeing them start to get nervous, I think that put a lot of pressure on the administration to rethink some of these approaches and how aggressively they want to approach things. So hopefully we'll see some moderation or stabilization over time, but there's no guarantees.
And for us, because we're dealing with family and individual wealth and their, portfolios, for us, it's, again, we're conservative by nature, but you can also be opportunistic. So anytime there's a dislocation or confusion, what we notice is that the most liquid assets get sold first. Again, hence the correlations going to one provides opportunities as things kind of bounce around and markets stabilize. Just looking at like the municipal bond market as an example here in California, you could have stuff trading below its NAV or where it should trade with a really nice yield. For someone in a higher bracket, a very nice after-tax yield. And eventually it comes back to one and you get a nice total return. So there's all kinds of opportunities that present themselves if someone has liquidity and they have time horizon.
Yeah.
I'll add also too on the tariff side. I think in terms of what I'm seeing in the forecast for the year, there's just a lot of tariff supply chain analysis, tariff mitigation strategies, like talking to clients about, just basically not reciprocal, but redundant supply chain strategies. And just, I think, kind of something for the foreseeable future. And then also what we're seeing too is that, there are companies that are sort of vastly less affected with tariffs, and so they're seeing private equity interest on the private markets where it's kind of smooth sailing. And so I think those are getting a lot of interest right now. And then also I think from a legal perspective, I think what the legal community is landing on is, in terms of material adverse effect, which is, something in the pre-call, I know, we had talked with Jason about, he had mentioned, what I'm seeing really now is in these agreements or in the LOI stage, basically buyers are saying, hey, the tariffs are not going to be a material adverse effect. And the sellers are countering and saying, okay, we're going to have a carve back in if there's an extraordinary impact on the selling company. So I think there's kind of this dance between what we're going to carve out and carve back in on MAE. And then also you're seeing in the reps and warranties, in terms of like what their tariff supply chain analysis is and what their actual impact is. And so I think that lawyers we're trying to kind of figure this out to kind of de-risk some of the transaction. I do think, Jason, to your point, there's just people that are on the sidelines that they want to wait. But for those that are moving forward, I think this is all working through. I think the lawyers are working through how to de-risk stuff. So there is some stuff moving. I think it's less optimistic than what we thought at the beginning of the year is, but I think it's still going to be higher than last year. We're already seeing higher transaction volume.
It's interesting, Jerome. You said there's some potential winners here, because there always are in all kinds of disruptions. So even, during COVID, pool businesses like boomed because people wanted to, build pools. They were stuck in their house. But in this case, it's hard to your first point, to supply chain planning, insourcing, plan Bs. It's really hard to do that and make long-term investments when you don't know what the rule's going to be, and it changes on a dime. So I think we need to have clearly drawn lines and understand what the terms of engagement are and where this thing's going to settle before you start to see any sort of positive effects of this whole tariff adventure. So it all feels very haphazard and unproductive at the moment.
No, I agree with you too.
Hey,
Yeah, go ahead,
um,
Constantine. Go ahead.
no, I was going to say, Jason, in respect to Caesar's point, amongst the business owners and managers that you deal with, particularly the ones that are affected with these potential supply chain disruptions, what are you seeing them do? In other words, are they saying, okay, we're just gonna, we're gonna onshore everything, we're gonna be able to do it in a reasonable amount of time? Or do you see them saying, we don't know where this is going, we got to weather the storm and just try to buckle down and get through it? What's the sentiment and what's the direction that you're seeing, your folks take?
Yeah, I think the short answer is it's kind of a variety, right, of we'll call it mitigating activities. So I think if you think about, if we're just going to focus, say, on the tariff piece of it, usually with a consumer products company that's, say, manufacturing in, let's say, the right now the bullseye, which is China, right? And you say, all right, well, how's that tariff going to be divided, right? It tends to be divided in a little bit of the manufacturer eats some of it. Usually the pricing, and most of our clients that are affected are definitely going to raise prices to a degree. So the ultimate customer is going to, call it, eat part of it. And then the business will eat part of it in the form of just thinner margins, right? So that's kind of more of the short-term idea of, well, how do I deal with this purely from a financial standpoint in the short run, right? And then the longer run, which we've seen this now happening for a number of years, is looking to diversify, right, your supply chain, and trying to find alternatives outside of China in particular, because I mean, ever since really 2016 or beyond, right, when the first Trump administration kind of did what they did, and then ironically, I mean, I guess we had the Biden administration who, during the campaign, was sort of talking like they were going to get rid of those tariffs that Trump added, but they never did, right? So, and now we're doubling and tripling down. So we've had this like China bullseye tariff situation now for almost 10 years. So during that time, companies that were very China based focused, a lot of them had diversified, right, already. And the ones that hadn't certainly are thinking hard about it right now. So that's a little bit of just the tariff part of it. But the one other point I'll make to I think Jerome and Caesar's points too is another theme we're hearing is, this is going to, I think, push even more consumer spending towards the services side of the equation rather than goods, right? And I think some of the service-based businesses are going to be some winners, because assuming for a moment overall spending doesn't drop, which it could, right? Usually in times of difficulty, you get a little bit of that sort of savings rate going up, but you're just going to see more of a shift because consumers are just thinking, well, I'm getting less value for my dollar in this whatever good that price just went up because of tariffs. Well, I'm just not going to buy that, and I'm going to likely spend that money somewhere more on the services side of the equation.
Yeah.
That's
So,
fascinating. I know.
and what do
all
you mean by
travel went down.
services, Jason? Exactly. Like, give me some examples. I'm curious. Is it like experiential stuff, like versus buying goods?
Entertainment, travel, going out to eat, like again, assuming you're going to spend that dollar
Yeah.
one way or another, you know, and we saw that, right? Because what we saw was during COVID, you had a big swing towards goods. Then post, you had a big swing back the other way towards services. And we've still been kind of services heavy still, like, I mean, you know, above kind of the historical average. I think this just kind of pushes that pendulum back even more a little bit towards services. But that's again, with that sort of assumption that the dollar is going to get spent somewhere, and that thing on Amazon that was $20 last week is $30 today. You just may not buy it now, and you may take your
Yeah.
$20 and do something else with it.
I can speak through experience. I was looking at a couple of tools on Amazon the other day. The prices had gone up. I said, you know what? I'll wait. I don't need it right now.
Was just thinking too, because, you know, I think Southwest announced they were cutting back flights. I know that airlines are going after the more affluent customers for business travel and high-end travel. So I'm wondering where do you think the dollars will land? So if let's say dollars go away from certain segments, maybe, you know, where I guess, or maybe you already answered it, Jason, but where do you see those dollars going? Like if it's not travel, where do you think it would go?
Well, like I said, I think entertainment is a big place. I also think, right, even within the different consumer goods sectors, you're going to have some people who are more advantaged than others, right? People who have U.S. based supply chains, for example, and then maybe it's not a movement out of the sector, but it's a movement toward a different, you know, ultimate, you know, retailer or brand, because they have an advantage that they can now press. So again, if we're going to use quick math, they were at $21 before, everyone else was at 20. Now the people that were at 20 are at 28. Well, their 21 looks good now, so they just keep selling at 21 and they get the sales.
Now, you know, going back to something that you said, Jason, um, and it all depends on the time horizon, right? But right now, as a result, we're seeing decreased earnings, increased consumer pricing, right? And that directly correlates into the price that an acquirer is willing to pay for a company in this environment. Do you see that? Do you see them thinking, no, this is going to stabilize? You know, we're still, you know, willing to pay based on historical earnings, or do you see acquirers basically saying, look, it's a different ball game now. Your earnings are going to drop. You know, we don't see any change in that in the foreseeable future, so we're going to price accordingly.
Yeah, I'll sort of echo what Caesar and Robert sort of were saying about opportunistic activity. I think what we see the most in these kinds of situations is either people pause or they get very opportunistic, right? And so the people that are quote unquote opportunistic, what they're looking for is the mispriced asset, right? The asset that the risk just isn't priced accordingly. So normally that's not terribly advantageous for sellers, right?
Yeah.
Typically,
Yeah,
you don't see that go up.
and I would say for us and talking to other hedge funds that we partner with, nobody thinks that the bargain is there yet, right? So things were at a very sort of elevated, historic, you know, prices, spreads, you know, PE ratios, et cetera. So it hasn't like come down enough for all of that money that is in the sidelines. There's a lot of it to sort of jump in yet. So I think, you know, for the most part, there's people just waiting. Even the ones that have money and aren't scared, they're not doing much either right now.
Yeah, Caesar, we're seeing, I mean, it's kind of like real estate. If you think about the major metro cities around the country, like everyone, you know, knows that a lot of markets are overvalued, but sellers aren't really willing to budge until they, you know, until they run out of liquidity. And then all of a sudden you start seeing transactions happen at discounts. And you're starting to see that in the real estate market in other areas, not in LA, New York, but in other parts of the country. You're definitely seeing that now. So the longer it goes on, the more this stuff becomes relevant.
Yeah, and you know, so I was speaking more about the public markets, but I could see that applying for the private markets as well. So yes.
And then I know Caesar, I know you guys, from what I remember, do some either fund of funds or fund seeding. Are there certain funds that you guys are looking at that you feel optimistic about for the rest of the year? Um, things that you guys are looking at?
Yeah, so we have a side of the business that invest in other hedge funds. So, we have access and regular touch points with a bunch of multi-strategy funds. But, like credit funds, right? We were hoping for more dislocation. So bonds, would trade down more and there'd be opportunities to buy and put money to work. But it hasn't really happened. Everything's kind of whipping around. And, if the baseline is here, just being down 10% is not enough. Nobody believes that, it's at a bargain level yet, or they're generally sort of the lack of uncertainty is kind of paralyzing. So we'll see, but nobody's really moving too much.
I mean, I'll throw out something that's, totally different topic here, but just with, again, with all this uncertainty, if you look at the tax code, which is going to sunset at the end of this year unless something's done, the estate planning code, which is going to sunset unless something's done, and you look at like the uncertainty and the discrepancy in prices of assets for estate planning, now is an amazing time to kind of like look at your balance sheet and figure out if there's things that maybe appear depressed in price that you can gift and do all kinds of advanced planning with. And we are seeing a lot of activity in the estate planning world right now.
Interesting.
I would have thought, Robert, people's base case is that those tax cuts are going to get extended. I mean, it's a major agenda item. But they could not. You're right, and they could lose control of. Well, I guess that wouldn't happen this year, right? The House.
Happened, yeah, January of 26. But again, there's a lot of uncertainty. No one really has clarity on this.
Yeah.
And Robert, when you're doing the pre-transaction planning with your clients, are you getting a sense for clients that are saying, okay, now's a good time, I want to do my estate planning, are they basically pulling back on the sell side, or are there some that are engaging, or getting or approach for transactions? Like, what are you seeing from your client side?
So interesting. We had a client's transaction fall through recently, and we have two that are moving forward. And I would say, again, when growth is scarce, an asset that's growing rapidly has more value to some of these firms.
Sure.
So going back to what Jason said, we're working with two AI service-based companies that are absolutely exploding in value right now. And their valuation's increasing, not decreasing in this environment. And so for them, yeah, taking advantage of valuations today versus in the future, 100%. We want to gift and freeze the value now in certain structures to get the appreciation out of the estate now.
That makes a lot of sense. No, I mean, AI has been frothy, I think, but there's just tons of money going that way, tons of investment. I think there was even a report today. I think Google was having return to work, and they're looking to shed some headcount so they can, invest more in AI. I think that's kind of what the bottom line of it was. So AI is not going anywhere for sure, and it's here to stay. So it makes sense that you've got clients that are, look in an asset like that. I think is a lot of upside.
Yeah. And just making sure, again, we're not accountants. We work with our clients, accountants and attorneys and bankers and everyone else. But, making sure they file their 83B elections, making sure they're using the QSB exemptions, which, making sure they know what cost seg and bonus depreciation are against income. I mean, there's all these different techniques you can use to help avoid unnecessary taxes. So we work with other professionals to make sure we can do that.
I need those names, Robert. I need help. Paying way too much over here in New York.
Not any better in California.
Yeah.
Aren't you going to get your Florida residency? What's going on?
I was going to say, Texas is open for business, guys.
Well, speaking of Texas, Jerome, we want to talk about some of the legal developments in the Delaware and Nevada
Yeah, I mean, I think kind of forecasting this year, there was a lot of indigestion from, private equity and different, Silicon Valley and other companies about recent Delaware case. To kind of boil it down, essentially, there's a standard of review that's the most onerous, which is an entire fairness review, meaning that if you have a conflicted transaction, it needs to be entirely fair to the corporation and the shareholders. And so there was an exception to that if you got a majority of disinterested directors and a majority of disinterested stockholders to sign off on it. What Delaware recently codified was basically in any case where someone's getting a non-ratable benefit, meaning like a controller, like a private equity firm, or maybe an owner who exerts control over the corporation, if they're getting some kind of like either like a financial package or some kind of liability waiver or some rep or something that others aren't getting, you basically will need either a majority of disinterested directors to sign off or a majority of disinterested shareholders to sign off. Why that's relevant is because there has been a lot of movement out of Delaware. I do think still it's, and Marty Lipton of Wachtell says, I still think Delaware is the gold standard, but there are companies reevaluating whether they want to be in Delaware. So I think that the amendments were meant to kind of quell the stop the bleeding, let's say. So I do think there is comfort around where Delaware is, but there are some who are, looking at other jurisdictions like Texas as a potential fallback. So I think just for the rest of the year, something to watch in terms of where corporations are and what, if you're professional working on a deal. Typically it's Delaware, but don't be surprised if you see something in Texas pop up.
Or Nevada, right?
Or Nevada, yeah.
They're big. Yeah. Interesting.
We also got a question in here. Constantine, did you see that? There's a question that just came out here.
Let's see.
It says, what do you believe is the new base case? Are you TikTok given the escalation of risk between US and China?
I mean, I think that the administration would still like for, ultimately TikTok to be not only owned, but like the algorithm fully administered inside the US. So I think that's still the goal. I think the goal is for it not to go away, but to be completely ported over. And like I said, it's not just about the equity, it's about, who's controlling and administering the algorithm. That's really where the issue is, because that's where all the data is ultimately going and being mined. So but I think I think when we saw earlier in the year when you got right kind of up to that deadline of the ban, if you will, that there was a lot of heartburn and pushback, and I think you saw the reaction from the administration. So I think what they're doing is they're trying to play matchmaker as much as they can to try to facilitate some kind of a deal. I don't know. I mean, we know, as we kind of were saying earlier, brinksmanship here is a tool that's being used quite a bit. So I'm not saying we're not going to get to the edge again, but I think the goal here is to try to get a deal done where it's no longer in the hands of algorithm, in particular, the hands of Chinese-based entities.
Now we've talked a lot about impact on U.S. businesses, et cetera. Let me throw out another question. Do you guys have any sense of how FDI, foreign direct investment into the United States, or from the United States out, is going with your clients? Are they talking about putting money into the United States if they're overseas? Are they talking about expanding to other jurisdictions and location if they're US based, or is everybody too busy just dealing with the day-to-day today to think about that really long term?
So I'll take a crack at it. So I guess let's start with what I know, and then I can guess at the rest. But what seems to have happened is the U.S. brand has taken a hit, right? In terms of our standing as a reserve currency, how we're viewed, at least internationally, especially by some countries that historically have been very close with Canada, etc. There seems to be less travel into the U.S., so some of these services type industries, I think, are going to end up feeling that. But in terms of what I can guess, in terms of foreign direct investment in or out, I would think you just go back to, we don't know what the rules are yet, so hard to make massive investments. If there are things that can affect the underwriting and the returns on that investment, right?
Yeah.
And one thing I can say, just, I mean, again, it's like from a broad brush, is that like international markets have significantly outperformed US markets this year, which is why we're always diversified in both sides. And just like on dollar and client flow, we're still working with clients that are, I still see money moving from Asia offshore into the US. I know that's not company specific, that's more individual specific.
Yeah, but that all impacts the overall economic picture.
I'll add too. I mean, there's a joint venture between Small Business Administration and Department of Defense. So they're looking to invest in critical technologies or companies that are involved with critical minerals around the world. So there basically is um, you know loans and favorable grants that the government's getting involved in. So I think that's an area of growth. Also in space, I mean, there's SpaceWorks and other programs because space becoming a real big defense area. If you can imagine, people being stationed in space in any kind of like war-like situations. So I do think that government is incentivizing critical defense areas. So we have clients that are exploring those options, and I think they greenlit. I think the government did 18 of these SBA DoD deals recently. So there's a lot of activity, and I think money being poured in on the defense side. And so then I think what's happening is the sort of like watch list or CFIUS list for countries is changing. So I think what you have to do is just look at which countries are investing, and but there are foreign countries that do want to invest in the U.S. in these kind of initiatives as well.
Also, to anyone who's attending, we want to just open up for your questions. We want to give room for our panelists to answer any questions that you have. Feel free to enter them in the chat or use our Q&A feature, and we will answer your questions live.
One thing I think we should touch on, which we haven't talked about directly, but maybe implicitly, is Doge and government cuts. Effectively, that is also austerity and bad for growth. So, there's a combination of things happening here that are just concerning and has caused a lot of the banks and research desks to increase their odds of a recession relative to where we were, pre, right? So there was a lot of optimism right after the election, less regulation, more business friendly. And, we've started to see all that go the other way with the tariffs and Doge and other things.
Yeah. Yeah, I think you're right, Caesar. The initial enthusiasm and optimism, while there are some beneficial aspects to it, I think many people fail to realize what a role the government plays in the economy, and certainly what a role, messing around with tariffs would play to companies as they try to navigate the world economy, not just our economy, but all the interrelations that have happened over the last few decades.
Yeah, somebody just put a question about whether the Doge cuts would have more of a regional or a national impact. I just noticed, actually, Jerome, you remember this, but Peter Hune from our law school just posted something that said the DOJ has canceled hundreds of ongoing grants that funded healthcare programs for police officers, victims of crime and sexual assault, and other things. So it seems to be sort of pretty broad. And I'm sure certain regions will get hit harder than others, but I don't think it's necessarily anyone's going to be spared. It's just what is the quantum of the impact, and we'll find out.
It'll vary as well. I mean, to Caesar's point, these are all federal programs, so they apply across all 50 states and U.S. territories, et cetera. And I think you will see different impacts in different sectors within a state. But I think overall, you'll probably see some similar level of kind of bottom line impact across the states.
Yeah, and I do remember, obviously remember Peter, right? So I think he was in the Attorney General's office when we were a classmate. I will say I think long term, having money in the hands of entrepreneurs and in the hands of business is better long term than in the hands of government in terms of growth and in terms of innovation. So if there are things that are counterproductive, that are fraud, or those things need to obviously get targeted. Obviously, you don't want to cut to the bone, so I think we got to figure that out. But I do think putting money, obviously putting money in the hands of entrepreneurs, putting money in the hands of business people, generally is a good thing. So for the economy, so I do think we're in this kind of like turbulence period, right? Where you're on the plane, you're smooth sailing, all of a sudden you hit turbulence, and it feels like, when is this ever going to end? So I think we're kind of in that turbulence phase, and I think that it is going to settle down at some point. The just question is, we don't know how long this is going to be and how intense it's going to be. But I long term, I think it's a good thing to get the money in different hands in the government.
Yeah, so I wasn't trying to imply,
Yeah.
I agree with you, Jerome, that Doge is necessarily bad.
Yeah.
It's just, because the deficit does seem very large.
Yeah.
But one, they have to execute on it and sort of be surgical, ideally, about what they're doing. But
Right, agreed.
even if they do it well, it just still means less money out there, right? So it's just still going to be bad for growth because it's austerity, right?
Yeah,
Understood.
that's a
No,
valid point.
And that may be the right thing to do long term, right? But
But it's going to lead to short-term pain. Yeah.
Yeah, and I think when the pain, well, if we're going to use the turbulence analogy, right? Like I think when the turbulence is over, what we're also going to find is some of the chairs have been shuffled, right? They've been moved, and I think that's intentional, clearly. So I think, obviously from an investment perspective, you're trying to guess here. Well, there's some people who, in industries that have been winners that are going to move into the, kind of loser column, or are going to have a net detriment from a lot of what's going on, and then others that are going to move into the winner, column. And obviously part of the strategy is trying to figure out, well, which is going to be which, right? And I think and that's clearly intentional, right? I mean, with a lot of this, it's intentional to try to move more manufacturing back to the US. It's intentional to, try to reduce the size of government's role in the economy and the amount of money that it takes in, and ultimately, and that goes out. So these are all very intentional things that, as we've all, I think, said, they're going to have short-term, very disruptive effects. So there is going to be pain, and for certain people, more pain than other people. And I think, again, if we're going to look at from an investment standpoint, and what I think people we deal with are trying to figure out is, and look to us for guidance on, is, well, who are going to be the winners and who are going to be the losers? Tell me. That's what people want to hear from us.
And
go ahead, Caesar. I'm sorry.
No, I was going to say, it's a good point. I'm personally just a little skeptical that, the attempt to bring more manufacturing jobs back is going to work when we're sitting here with, 4% unemployment, historically very low. We're deporting a lot of our cheap labor. And I don't know. I feel like America has moved largely past that into like an intellectual services economy. Like who really wants those jobs, in mass? So it's a good thought experiment, and I hope it works because, but in practice, I'm curious to see how it plays out.
So let me ask each of you to kind of leave us with one key point to bear in mind, going forward as we're navigating 2025. Hopefully it's an optimistic point, but
I could say something. It's kind of given the analogy of a movie. There's a beginning, a middle, and an end. Every movie has a beginning, a middle, and end, and the plot's always different. But like, I kind of feel like we're in the middle of the movie right now, and we have clients. People say it's different this time. That's the key word. It's different. Red flags go up. Human psychology is always the same. Fear and greed have driven market cycles since the beginning of time. People tend to repeat the same mistakes. History has different rhymes, but always kind of has a similar flow to it, again, with mistakes. And so for us, we just, stay the course. If there's nothing drastic changing in your life, if you didn't lose your job, if your business is still intact, if you have a safety net, if there's nothing majorly wrong with you personally, then maintain the course and don't do any rash decisions. So for us, it's just like we're pretty much therapists during periods of time like this. But I just tell everyone, we'll get through it. There'll be some type of resolution. There will be an end to the movie, and we'll get through it.
Great point, Robert. Great point. Jason, Caesar?
I mean, so I would say it times like this, highlight the importance of being diversified, and trying to be in things that are defensive as part of your portfolio, whether that's 5%, 20%, 40%, it's up to you. But, you should try and have a balanced portfolio that ideally, doesn't all move in the same direction with anything, really. Any one thing.
Bring it home, Jason.
I guess I would say, and my disclaimer is this coming from a guy who spent a lot of time at the blackjack table. I would say that I would say get excited about times of uncertainty and volatility, because fortunes are often made during those times. So I think, honestly, instead of maybe choosing to look at the fearful side of things, look for the opportunistic side of things, because usually that's what's happening. While you're focused on what's going wrong, you're missing out on opportunities that you could be taking advantage of. So yeah, learn to get excited about it. Like with our clients, that's kind of how we try to advise them. Is like, okay, well, we know the difficulties that certain scenarios may cause, but what are the opportunities that they're causing, and how do we also take advantage of that, so we at least balance out, if not ultimately come out ahead.
That's an excellent point, Jason. Excellent.
I'll add one quick point. If you look at the vintages of companies, some of the best vintages, meaning like private markets where investments have been made, have been in the most difficult times. So, conversely, the 21, 22 vintage is not shaping up to be a very good one. But this vintage, 24, 25, because it's so challenging, it's going to be very scrappy, resourceful, adept, agile, entrepreneurs who have figured out how to be successful in this environment. And so I think that's why I think it's a good time to be in the emerging markets.
And with that, we'll close out our virtual panel for today. This is one of my favorites, guys. Thank you so much for joining us. Thank you to everyone that's in the audience for joining us today for our 2025 M&A and Alternative Investment Forecast. This is recorded, and we will be sure to send it your way. Please feel free to share it with anyone that you think will benefit from this. We hope to see you on the next one, and a huge thank you to our panelists today. Thank you, Jason, Caesar, and Robert, for joining us today.
Thank you, everyone.
Thanks, guys.
Thank you. Take care.